Moving on to state income tax issues. As promised, we're dealing with foreign, out of country issues as well as states, because gotta love those states. They want their hands on your money as well. Now, while mostly in this exam we're dealing with federal taxes, because it would be a little crazy to deal with state taxes, as I'm just finding out there are 50 of them. That would be incredibly difficult. However, this is sort of a topic that, it generally applies throughout state and local taxes, and no reason we can't go through it. I mean, this is something that's also tested. That's why it's here. If it wasn't tested, I wouldn't be including it. Now, multi-jurisdictional tax issues arise when a business operates in multiple states, requiring it to navigate the various state income tax laws and regulations. Now, you may be thinking, oh, why is my favorite fast food chain not in my state? Why is it in the state next to me and in the other states? Well, this is a big issue. I'm not sure about the legal ramifications of fast food and opening up restaurants, but I am familiar with the tax implications. So, for example, me being from New York, there are many fast food restaurants or just restaurants or businesses in general that do not enter the state, because if they open up one location there, boom, they have to deal with all of New York and its complex laws. You got Texas has a lot of fast food and just other chains where within Texas, they've pretty much stayed within Texas. Sure, maybe they try to advance and move to other states. But for example, Texas is a big enough economy that they could just stay there, not have to move to other states and worry about being taxed or dealing with the implications of opening up business in other states. California, sorry to y'all in California, I'm not as familiar with California. All I know is In-N-Out Burger is phenomenal. Now, some common state income tax issues faced by businesses with multi-jurisdictional operations include, we got Nexus. We want to make sure we understand this concept and memorize it, just be familiar with what Nexus is. This is determining whether a business has a substantial enough presence or connection, which is the Nexus, connection with a state to be subject to its income tax laws. Now, Nexus rules are going to vary by state and can be triggered by factors such as having a physical presence. Yeah, if you open up a location, that's what I'm saying. If you open up a location in New York, then you do have Nexus with the state of New York, and as such, you open up the floodgates to dealing with all the implications of that. If you don't do business in New York at all, if you don't have any physical locations or employing people from New York or generating a certain level of sales within that state, then you likely won't have Nexus and you won't have to deal with that. If any of you are starting to think, well, this sounds a lot like we had the Wayfair sort of legal situation. Amazon, sometimes you're paying tax on items, sometimes you're not. What's the deal with online purchases? Yeah, that's a whole thing. And it's pretty much been resolved by this point whenever you're listening to this. But that's just something that's an application of this in the real world. Is Amazon started off, they say, oh yeah, we're only dealing in one state, but we're shipping things to every 50 state, but we're not going to pay tax on that. Obviously, eventually that got settled, and there's a lot of implications with that decision. Now, businesses must continually monitor their activities in each state to make sure they're compliant with these Nexus rules. Makes sense. What about apportionment and allocation? We're going to see examples of these as well. Now, businesses with income from multiple states have to allocate and apportion their income among the states in which they operate. Got to share the wealth. If I'm 90% operating in Oklahoma and then doing a little bit of 10% business in Missouri, well, that's going to be a little strange if I am not paying any Oklahoma tax, because I'm using 90% of my operations are in Oklahoma. I'm using their roads, using their facilities, infrastructure, everything like that. We have these different apportionment formulas. We'll see examples that based on property, payroll, and sales. Does that make sense, right? If you have the majority of sales in one state, that could be a way to allocate. If you pay the most people in a certain state, or if you have the most property in a certain state, that's something that for sure we'll see. Businesses have to understand and apply these formulas and everything to make sure that we have an accurate representation of our liabilities. Lastly, here we've got combined or consolidated reporting. Now, states have varying rules regarding combined or consolidated reporting for affiliated groups of companies. Some states are going to actually require combined reporting, consolidated tax returns, where the income and apportionment factors of all affiliated companies is combined, while others allow or require consolidated reporting where only the income of the unitary group is going to be combined. So it's just basically having to know that, yeah, every state does it differently. That's a TLDR on that. Understanding and complying with these is going to be complex, and gotta love it. That's why, yeah, maybe you don't want to open up operations in another state. You just stay in a state that's large enough to fulfill your operations and create profit. Now, Nexus, this is going to refer to the connection between a taxpayer and a state or locality, such as a city, and they got their own tax rules for sure, that gives rise to the obligation to pay taxes in that jurisdiction. The concept of Nexus is going to be important because I said so, but also in determining whether a taxpayer is subject to state and local taxes, and if so, the type and amount of taxes owed. Now, generally, a taxpayer has Nexus with a state or locality. This is what we covered before, but now we're diving into the specifics of Nexus. If they have physical presence, that's the easiest way to determine if you have Nexus, such as a business location, employees, or property. Another general example, if you just drive through, if you have people who delivery drivers for your company that just drive through one state, every once in a while, that's probably not going to be Nexus, but we're going to give a lot of examples as we go through. However, the concept of Nexus has expanded in recent years to include economic activity in a jurisdiction, such as sales or revenue generated from online sales. As I mentioned, this was a big thing, big component, and it will continue to evolve as there's just different ways to transact in our modern world. The rationale behind Nexus is that taxpayers should pay taxes in the jurisdictions where they benefit from the services and infrastructure, like we talked about, makes sense. For example, we consider a company based in Texas that sells products online to customers in California. The company has a physical location and employees in Texas, but does not have any physical presence in California. However, because the company generates sales revenue from California customers, it may have Nexus with California and be required to collect and remit California sales tax on those sales. However, they're likely not going to have to pay many other taxes such as income tax, property tax, payroll tax, anything like that to California. Now we're going to see a bunch of examples that do trigger Nexus. Now Nexus is what we talked about as well, sufficient physical presence. It's a term used in tax law to determine if the company has a tax obligation in that particular state or municipality or locality. We've got certain activities that create Nexus while others do not. Let's see all of our examples. So first off, we've got an example of acceptance of an order within the state. So if a company accepts an order within the state that they're operating in, either through a salesperson or an online platform that specifically targets customers in that state, this can create a sales tax nexus. Example of being a furniture retailer based in California. They accept an order from a customer in Texas through a sales rep stationed in Texas. This is going to create a nexus in Texas for the furniture retailer. Next, we got collection of delinquent accounts. Well, when a company actively collects delinquent accounts, so those accounts receivable that were never paid to you, within a state, it may be seen as engaging in business activities in that state, thus creating nexus. For our example here, we have a software company in Florida. They're going to hire a debt collection agency based in New York to recover overdue payments from New York customers. This action may establish a nexus in New York for the software company. If you see, it keeps saying you may establish, may do this. We're not going to have to be absolute experts at this topic. We're just going to have a good general idea of what's going to create nexus. Yes, this would, for our purposes, create nexus, but in the real world, there's so many other layers and rules that maybe it would supersede that. But we are taking this from a baseline level that we need to know for the exam. Next up, providing installation services with the purchase of tangible personal property. If a company does sell tangible personal property and also provides installation services within a state, this could create nexus. As an example, we've got an electronics company headquartered in Nevada that sells large appliances to customers in Arizona and sends employees to Arizona to install the appliances. That is going to be the nexus creating event. It's going to establish nexus in Arizona for the electronics company. Next, for maintaining an office or warehouse, if a company has a physical location, such as an office or warehouse, factory, anything like that, yeah, that's going to create nexus. I mean, you're very much using the land within that state. We've got an online clothing retailer based in Oregon, opens a distribution center in Washington. The presence of the distribution center in Washington is going to create nexus for the retailer in that state. Next up, employing staff within a state. So hiring employees, sales reps, or contractors, or anyone like that who work within a state can also establish nexus. For example, a marketing firm headquartered in Georgia employs a team of remote workers based in North Carolina. The presence of these employees in North Carolina will create nexus for the marketing firm in that state. Now we're moving on to activities that do not trigger nexus. Kind of mentioned a little bit of a common carrier one before. So delivery via common carrier, shipping products to customers within a state using a common carrier like UPS, FedEx, or the USPS, or anyone else. I don't know if Amazon's doing that for other companies. This generally is not going to create nexus. Common carriers, you don't own them, right? I don't own the UPS trucks that are shipping my goods for my business. Example here, a toy manufacturer in Ohio ships products to customers in Illinois using FedEx. This delivery method does not establish a nexus in Illinois because, well, A, you could say it's the rules. B, I'm trying to give a rationale and idea to it, but I mean, these are the rules. Passive advertising. So if we're specifically targeting people in a specific state, like mentioned before, then that would create nexus. But if we're just generally putting advertisements out there online, I don't know if anyone's familiar with how Google works, but a lot of times you need, even if you have a completely online business, with your Google account for that business, you need to select a physical location. They do that to prevent fraud and other things. But within that, yes, that would generally create nexus. If you have your Google account set up in Florida, and you have your advertising specifically targeted toward Florida. However, if I'm just somehow putting passive ads throughout the entirety of the internet equally, yeah, merely advertising products or services within a state without specifically targeting customers there, against also kind of like sending them, let's say, specifically emailing certain demographics, that is going to create Nexus. But in this case, this would not create Nexus. An example, a tech company in Massachusetts places an ad in a national magazine that reaches readers in various states. This form of passive advertising does not create Nexus for the tech company in those states. We've also got infrequent sales or transactions. Yeah, if you just got one or two sales, that's probably not going to create Nexus. Occasional or isolated sales within a state, which do not constitute regular business activity, may not create a Nexus. An example here being a small artisan business in Vermont sells a few handmade products at a one-time craft fair in Connecticut. This infrequent transaction likely does not establish a Nexus in Connecticut for the business. Next up, we've got engaging independent contractors. So yeah, where we said earlier that if you have contractors, it could create Nexus, that's one where we're not going to really dive into the specifics of it, just giving you a general idea as to what we're seeing. It's kind of like a common carrier. These aren't, and kind of dealing with agency law, which we will see later on, a lot of times these may not be agents. So, I mean, I'd say generally, if someone's an agent of you, then yeah, that's going to create Nexus, but we'll deal with that in agency law. Hiring independent contractors for specific tasks or projects in a state as opposed to employees may not establish Nexus depending on the nature and extent of their activities. Again, this deals significantly with agency law. An example here is that a web design company in Colorado hires an independent contractor in Kansas for a single short-term project. This engagement may not create a Nexus in Kansas for the web design company depending on the contractor's activities. Next up, we've got selling digital products or services. I'm sure this one is constantly evolving because it's online sales and the government's slowly catching up with what the internet is. In some states, selling digital products or services such as software or online courses may not trigger a Nexus, as these transactions may not be subject to sales tax or other taxes. Yeah, again, it's not like we need to be up to date on the current tax law with this, but as we become more of an online service-based economy, that's going to be huge. An example here being a digital course provider based in California sells online courses to customers in multiple states. This activity may not create a Nexus in those states depending on their respective tax laws for their digital products and services. All I'll say is I can't imagine being in a physical business. It's harder and harder each day as time goes on. Online businesses are where you're providing services and digital goods. That is a lot easier. You don't have to worry about workers' comp, people getting hurt, transportation, anything like that. But if any of you are working in a physical industry, props to you. Let's talk about apportionment. Right, we had an introduction to Nexus, apportionment, allocation, all that. We're going to see some slides on what we're dealing with here. Well, apportionment and allocation, these are methods used to allocate income and tax liability among multiple jurisdictions. When a taxpayer has activities in more than one state or locality, these methods are used to ensure that each jurisdiction receives a fair share of tax revenue. Makes sense. It's totally fair. Apportionment is the method, so specifically apportionment, this is the method of dividing a taxpayer's income among multiple jurisdictions based on a formula that takes into account various factors. We saw this earlier. Sales, payroll, and property, these items would very much likely tell you if you have Nexus. The rationale behind here is to allocate income to where you have significant economic presence and where you earn your income. Now, for example, if we have a manufacturing company that has operations in multiple states, as many manufacturing companies would, the company's income is apportioned among those states based on the percentage of its sales, payroll, and property in each state. This is ensuring that every state gets a fair share. Got to spread the wealth, got to make sure we all get a cut of the pie. Now, allocation, this is going to be the method of assigning a specific amount of income or tax liability to a particular jurisdiction based on a specific activity or event. Allocation is used when apportionment does not adequately capture the taxpayer's activity in a particular jurisdiction. We see how they're quite similar, but when are we going to use them? Now we know. For example, consider a consulting company that provides services to a client in a particular state. The income earned from that client may be allocated entirely to that state, even if the consulting company has no physical presence or other activities in that state. This is going to ensure that the state where the services were provided receives the appropriate share of tax revenue based on the activity performed in that state. Let's dive into an example of allocation. Nice simple one here. Assume that John is a resident of California but received interest income from a bank in New York. He received $5,000 in interest income during the year. California has a law stating that interest income should be allocated to the state of residence. Therefore, John has to allocate the entire $500,000 of interest income to California on his tax return. I mean, this is, we could dive, not that this would be in the exam, but there's a whole opportunity to dive into the complexity here. For example, when I was living in Kansas City, living in Missouri, working on the Kansas side, oh boy, dealing with that. If you're in New York, maybe you live in Jersey, you're working in New York. We got many possibilities of living in one state and commuting to the other state to work. Those are, I think, the two biggest examples for me, but I'm sure there's many others out there. Here's a nice little recap of everything we saw. If you want to skip it, feel free, but then you'll be missing out on the beautiful sound of my voice. Nexus, this is the minimum contact a taxpayer has to have within a jurisdiction to pay their tax. Federal law prohibits states from imposing state income tax, which is not sales tax and not franchise taxes, if the following points are present. So only business in that state is the solicitation of orders for sales. And basically what this is saying like, okay, federal law prohibits you doing state income tax if there's no nexus. So the orders are sent outside the state. Orders are filled by shipment of delivery to a point outside the state. Just a kind of a recap on the important points to know about if there's no nexus. The following may cause corporations to pay income tax in the state, and these would be nexus creating activities: owning or leasing tangible property or real property, sending employees to that state for training or work, soliciting sales in that state, providing installation or maintenance to customers within the state, and accepting or rejecting sales orders in a state or accepting returns. These are nexus creating events. Now, for allocation of non-business income, you want to allocate the income to the home state, and we're going to deal with dividends and interest income as we saw. For apportionment, this is the first one we would do, and if apportionment doesn't work, we go to allocation. We're going to average out the property, payroll, and sales. We're going to take the state's individual amounts for each category and then divide that by the total amount for each category. You're going to add the percent together and divide by 3 to get the total overall percentage if there's 3 states. A lot of examples you'll see just have 3. And then you're going to take the apportionable income times the overall percent. And that's about it. This was another great lesson. We covered a lot of ground. I hope you're all doing well, and I'll see you in the next one. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.